On August 22, 2025, researchers ran an experiment a lot of Wall Street was quietly dreading. They opened 5 AI models, ChatGPT, Gemini, and others, and gave each one the same order. Assemble a portfolio of US stocks to outperform the S&P 500 index over the next year. Then they let it run. For 8 months, they tracked every recommendation in real time. This wasn't a backtest where you already know how the story ends. This was live, over 1,200 daily portfolio observations with real market conditions deciding who was right. The results landed in a preliminary working paper for the National Bureau of Economic Research. And to be clear, NBER working papers circulate for discussion before peer review. So treat this as early evidence, not a final verdict. But even early, the data draws a hard line between the magic these tools get sold on and the actual math of the market. Some models genuinely crushed the index. Others built portfolios so aggressive they barely resembled a diversified investment, more like a bet than a strategy. So today, we're setting the screenshots and the hype aside to ask one question. Can artificial intelligence actually beat the stock market? Or is it just really good at sounding confident while it loses your money? This is AI Investigates. And if you've been on social media lately, you've probably seen a screenshot of a chatbot stock picks with 3 rocket emojis and a caption like, "AI just made me rich." We wanted to know if that's real or survivorship bias with better marketing. So in this video, we're pulling together the actual research, the studies, the SEC cases, and the NBER data to find out where AI genuinely earns its keep, where it's quietly loading you up with risk you didn't ask for, and where companies just lied about having AI at all. Stick around for that last one. It involves a guy running a fake trading platform out of his house. Let's start with why so many people already trust a machine with their money. Ordinary investors aren't waiting for academic peer review. According to a survey from investing.com, worth flagging that they also sell their own AI investing products, so they have a stake in the answer. Nearly 2/3 of retail investors already use AI to help make decisions with their own money. Among those users, 65% say it's already improved their performance. Here's the part that should give you pause. When you ask a human advisor for stock picks, that person usually needs credentials, a license from FINRA, the Financial Industry Regulatory Authority. Getting licensed means passing exams, following conduct rules, and in many cases, owing you a fiduciary duty, a legal obligation to act in your best interest, not theirs. The AI model giving you advice right now has none of that. No license, no exam, no fiduciary duty. It can't be fined or barred the way a licensed advisor can. A study in the journal PLOS One found that 95% of AI-generated investment recommendations come wrapped in a fine print disclaimer. Functionally, that disclaimer isn't there to protect you. It's there to protect the company, buried in text small enough that most people scroll right past it. Meanwhile, the AI tends to deliver its advice with what researchers called medium to high assertiveness. Confident, plausible-sounding logic, stated like fact. A system with zero accountability that talks like it knows exactly what it's doing is a very easy thing to follow right off a cliff. So, does the lack of regulation mean these tools are bad at this? Not necessarily. Some of them are genuinely good. Let's look at the case for AI first, before we get to where it falls apart. If you only look at the early academic data, it's easy to see why people are excited. There's real peer-reviewed evidence that AI can spot patterns humans miss, or at least miss fast enough to act on. In a study by researchers Pelster and Val, ChatGPT-4 rated the attractiveness of different stocks in a live experiment, and researchers found a genuine positive correlation between those ratings and how the stocks actually performed afterward. The model was especially sharp at updating its opinion when news broke or a company posted a surprise earnings result, faster than a human analyst typically could. Then there's the work of researchers Lopez Lira and Tang, who found that ChatGPT-4 could predict how the market would react to a piece of news just by reading the headline. A 90% hit rate. That sounds enormous, so pay attention to what it actually measures. That 90% is for the initial, non-tradable reaction. The AI correctly guessed which direction the price would move the instant the news hit. But in the real market, that move happens in seconds. By the time you could place a trade, the opportunity is usually gone. The AI was right. You still might not have made a dime. The most convincing evidence comes from the professional side. Hedge funds, the private investment partnerships that manage money for wealthy clients and institutions. A study in the Review of Financial Studies found that hedge funds adopting generative AI earned 2 to 4% higher annualized alpha than funds that didn't. Alpha, in plain terms, is the return an investment makes above what the market already delivered. The skill component, separate from just riding a rising market. A sustained 2 to 4% edge is a genuinely big deal in an industry where fractions of a percent separate winners from also-rans. So for the biggest players, with in-house data science teams and decades of experience to sanity check what the AI spits out, this technology appears to be providing a real, measurable advantage. Which raises the obvious question. If AI works this well for professionals, why doesn't it work the same for the rest of us? That's where the NBER data gets uncomfortable. When the NBER researchers looked at what these AI models were recommending to ordinary households, the magic started to look a lot more like a dangerous lack of diversification. The models weren't building balanced portfolios spread across industries. They were building concentrated, tech-heavy bets. ChatGPT 5.0, for example, consistently put 18 to 20% of an entire portfolio into one stock, NVIDIA. One company, a fifth of your money. Zoom out across all 5 models, and semiconductors alone made up roughly 41% of the average AI-built portfolio. Compare that to about 20% in the S&P 500. The AI's real strategy was less outperform the market and more buy whatever's trending. Its picks got roughly 10 times more media coverage than the average company on the exchange. To see why that's risky, you need one more concept, beta, which measures how much a stock swings compared to the overall market. A beta of 1 means it moves right along with the market. Think of it like a car following the speed of traffic. A beta above 1 means it's weaving and accelerating harder than everyone around it. Bigger gains on the way up, bigger losses on the way down. The individual stocks these models picked averaged a beta of 1.05, barely more aggressive than the market. But once combined into a single unconstrained portfolio, told simply to beat the market with no other guardrails, the overall beta jumped to 1.6, 60% more volatility than the index itself. Stack enough correlated, trendy tech bets together, and the risk compounds in a way that isn't obvious from any one stock alone. The trading behavior was just as reckless. Some models rebalanced the entire portfolio every 1 to 2 days. And every trade carries a transaction cost and, outside a tax-advantaged account, a tax bill that quietly eats into returns. After all that risk and churn, here's the punchline. The AI's only statistically significant win came at the 6-month mark, a 748% excess return. That's the headline number holding up the hype, and it doesn't survive the next test. Researchers applied a DGTW adjustment, which compares a stock's performance not against the whole market, but against other stocks with similar traits, like size and momentum. Essentially asking whether the AI found real value or just rode the same wave every momentum trader was already riding. Once they corrected for the AI simply trend-chasing large tech names everyone already owned, that win evaporated completely. One outlier. Gemini's actively managed portfolio did post a significant return, but researchers flagged that it was based on just 18 days of data during an unusually strong market. Not exactly a result to bet your retirement on. So, the professional's 2 to 4% of real, sustained alpha is one story. A retail chatbot piling 20% of your savings into a single chip stock is a different one entirely. And some companies didn't even bother building real AI before selling you on it. As the hype around AI investing grew, some companies figured out it was easier to lie about having the technology than to actually build it. The SEC has a name for this now: AI washing. In March 2024, the SEC charged Delphia and Global Predictions with making false statements about their AI capabilities. Delphia had spent 4 years telling the press and posting on its own website that it used machine learning to identify winners early. The SEC investigated and found the technology simply didn't exist the way the company claimed. The Reimar Capital case takes it further. According to the SEC's order, Reimar raised $3.725 million from 45 investors to fund an AI-driven trading platform. At the time, the SEC found no trading application existed. Not a limited version, not a beta, nothing. The extensive infrastructure of engineers Reimar bragged about actually belonged to other companies it had no stake in. And the 46% annual returns it advertised to lure people in belonged to somebody else's results entirely. The person running it, CEO Itai Lips, was the firm's only employee, working out of his house in California. The SEC found he acted with recklessness or outright knowledge of the deception. Board member Clifford Boro was also charged, though the order pinned his failure on simple negligence for taking Lips's claims at face value. Everyone settled without admitting or denying the findings. Lips paid a $250,000 civil penalty, was barred from the securities industry for 5 years, and was ordered to pay $213,611 in disgorgement, legal language for handing back money he shouldn't have made. He didn't pay that in cash. The SEC let it be offset against capital he'd already advanced to the company. Here's the takeaway. None of these people were caught by some brand new AI law. There isn't one yet. They were caught using fraud statutes that have existed for decades. The technology changed. The scam, and how regulators catch it, did not. And even when the AI behind a product is completely real, no scam, no vaporware, there's still a catch nobody's advertising. Whatever edge it has probably won't last. Even when the AI edge is real, it doesn't seem to be permanent. 3 separate research teams have independently landed on the same conclusion. The more people use AI to trade, the faster its advantage disappears. Researchers call this alpha decay. A team from NYU tracked a factor's half-life, how long it takes a winning strategy to lose half its effectiveness once others catch on and copy it. In the pre-AI era, that half-life averaged around 60 months. In the AI era, it's collapsed to roughly 18 months, a Red Queen race, after the character who has to keep running just to stay in the same place. But there's one surprising finding that pushes back against a common fear. A lot of people worry that if every fund runs similar AI models, they'll all pile into the same trades at once. The kind of synchronized, herd-like selling that can crash a market. NBER working paper 35273 found the opposite. AI-driven hedge funds actually show lower return movement than their human-run counterparts. Different AI models seem to be finding different niches rather than all converging on the same handful of stocks. A real point in AI's favor, even as its edge keeps shrinking. So where does all of this leave us? So, can AI beat the stock market? The honest answer isn't a clean yes or no. The edge is real, but it's small, shrinking, and unevenly distributed. For the giants of Wall Street, with the compute, talent, and guardrails to use these tools carefully, it's a genuine 2 to 4% advantage. For the average household typing a prompt into a free chatbot, it often looks more like a high-risk gamble on whatever's trending that week, dressed up in the language of data science. So, if you're looking at an AI-powered investing product today, ask this before you hand over $1. What is the actual audited track record? Are those returns live or back-tested on data the model had already seen? And if the AI is really this good, why is the company charging you a fee to use it instead of just trading with it themselves? The machine might genuinely be smart. But the market has always been a reflection of everyone else's intelligence too. Millions of other traders, analysts, and now other AI models, all competing for the same edge at the same time. In a race that crowded, there's no such thing as a permanent winner. This is a documentary, not financial advice. Nothing in this video is a recommendation to buy or sell any security. If this saved you from believing your next stock tip out of a chatbot, do us a favor and hit like. It genuinely helps this channel keep making videos like this one. Subscribe if you want more of these deep dives into where the AI hype actually holds up and where it doesn't. Thanks for watching.